Good morning, ARMR Insiders. Welcome to Stock Market Investing with the ARMR Report. This is the morning meeting. I appreciate you guys spending your time with me before the market opens so I can get my head straight and see if I can help you get your head straight and figure out how we're going to take on this day. So I titled this morning's call OPEX Friday, right? OPEX is Friday, and what are the implications for the week and how it is affecting what we did yesterday. So let's go over this real quick. Couple of thoughts off the top of my head. Let's get the elephant out of the room. AT&T is down, 6%, trading at $29.50. We paid $30, I'm thinking 16 cents for it. We've picked up a dividend. Our average price is right around here. Okay, so thank you, Eris, for putting that information into the room from the Kramer report, I guess, talking about how their deal looks to be a means for them to cut the dividend, right? And so if that's going to happen, there'll just be a whole bunch of money that comes out, even if it turns into a good asset later, because it'll be 100% focused on the 5G rollout. Everybody who owns it for a dividend will dump it, and so that'll just put too much pressure on the stock. And so while I've been saying for the last couple of, I don't know how many weeks, that this is the easiest money I might ever make this year, hey man, I don't force my will on the market. Simple ARMR investing rules. We raise stops to break even. Once an asset's up enough, it comes back down to break even, we sell the stock. It doesn't make a difference what I think the stock's going to do between now and the end of the year. So from a simple managing success, managing risk point of view, when you have a stock that runs up, then there's new fundamental information that kind of interrupts the fundamental story of why it was on the whiteboard to begin with. In this case, a dividend cut, ruins it. It's a dividend stock. And it comes back to break even. You step aside, use the capital for something else. There's a ton of ideas out there for us to get involved in. So how am I going to trade it today? I usually don't execute first thing in the morning. But I might in this case. I might just step aside because obviously there's just too much noise around the stock. We don't know. They haven't announced a dividend cut, but when you go through the process of them divesting assets and cash flow and what that means, it suggests that there'll be a dividend cut, and that's what people are figuring out. So my guess is I'm just going to sell the stock at the open, which will end up exiting the position around break even. So no harm, no foul, and we'll just use the money for something else. All right, so now let's get on to the stock market. Yesterday, so in our ARMR Index Only portfolio, right, we have 3 portfolios. Index Only, Swing, and Invest. Index Only was 100% cash when we go Risk Monitor Red. We go Risk Monitor Red because we get stopped out of a number of index positions. We had 3 down days in a row. Usually that's a major negative sign, but not in this market, and I'll get to that in a minute. And so the first thing we do in the index-only portfolio, we go to cash, then we wait to see how the market behaves over the next X amount of days, and we look for the next green signal. So first thing to remember, Risk Monitor Red is not calling for a bear market. Sometimes we protect capital and a bear market unfolds. Last year in February, okay? But most of the time, the market trends higher. So you're going to get a whole bunch of Risk Monitor Reds that are really just the next, they're just right around the corner from the next entry point as the market goes and tries to make new highs. So what I like to do in the index-only portfolio is look at what's happening. If there's confluence across the board, where every index looks the same and everything's being dumped, that's a time, and I'll tell you this. I mean, I'll let you guys know, and I guess I have been letting you know, even when we went Risk Monitor Red last week, there's a rotation going on in the market, and we don't know if the leadership of last year's collapse is going to just wreck the rest of the market, or if there'll continue to be rotation. If there continues to be rotation, then you're going to get a series of Risk Monitor Reds when the leadership gets wrecked and just everything starts to come in. But then the rotation picks up, money doesn't leave the market, and other assets start to run, driving the market higher. And so the Dow, the S&P, the value index, even the small cap outperform the momentum, the NASDAQ, and the IBD 50/ARK Innovator funds. And so what I like to do with that portfolio is I go to cash first to protect capital, and I wait and see. If there's no confluence, then I start looking for reasons to put money back to work. So let's go look at what happened yesterday. Okay. So the first thing I would say is there's two ways to play this. And we played it differently in the swing and the invest portfolios, right? We only had 50% cash. We were still 50% invested. We didn't sell everything. We didn't go to 100% cash like we did February of last year. Okay. And the reason is right here. The S&P closed right on the 50-day and right at the uptrend. Okay. So while the index only portfolio, and I manage 3 portfolios, my own capitals in 3 different disciplines. Okay. So in one discipline, I go to 100% cash. In the other 2 disciplines, 50% cash roughly. Actually, it was 40% in the invest portfolio, 50% in swing. Okay. So if the market had plummeted again and taken out and closed below these prices here, I would not be adding new ideas to the portfolio in the index only, and we would have been selling more out of the other portfolios. Instead, it stopped right where it should and bounced. Okay, I say to you, 2 up days is normal. And if yesterday had imploded again, I would not have been adding anything to the portfolio. But instead, yesterday, as you can see, tested the low. We're looking at the S&P now. It tested the low of Friday and held. Okay. Let's go look at the Dow real quick. Okay. There's absolutely nothing in the Dow that suggests the market's going lower. A breakout, a pullback, the 3-bar reversal is ugly, right? That could be possibly the beginning of selling. But if there's no follow through and you see median bar reversal right here, then this is just consolidation, letting the rest of the market catch up. Okay, let's look at small caps for a second. Okay, small caps are consolidating. They broke below and immediately recovered. Okay, and so what I'm doing here is I'm saying I'm going to put capital back to work in the index only portfolio with the low of this big down day right here as the stop on all these positions. If that actually the Thursday low, if the Thursday low is taken out, then we'll be, first of all, the risk monitor won't change. It'll still be red, and I'll take some losses on these new positions I just put on. But it'll be small, okay? Small losses. I know exactly what my stop is, and it's tight because we bought close to the low yesterday, okay? And if that happens, we'll go back to cash there. It'll still be risk monitor red, and probably we're raising cash everywhere else. But what I'm looking at right now is a couple of factors. First of all, it's OpX week. Every day that the market doesn't plummet puts more and more pressure on put buyers, put owners into OpX Friday to sell their position because of the decay, the time decay. So this is called Vanna charm. So if the market's not going to plummet, typically volatility compresses this week. And when that happens, when volatility compresses and you get decay, it puts us into a positive gamma situation in the market, and the market starts to lift. Okay, and so we see that when we look at spot gamma information. Last week, if you recall, all of the indexes were in a negative gamma position. So it looked like the end was near, and it looked like the market was going to implode, but the market stopped right at the location it needed to hold, rallied immediately. We're back into positive gamma position, and we have an OpX Friday, meaning that we're going to see compressed volatility, which means there'll be Vanna charm, which means there'll be support in the market. So I put capital back to work. And here's the last piece to the puzzle. This is a graphic representation of the ARMR algorithms. And you can see there's a little caret here. This is a little buy caret. The buy carets show up. This is just a basic form of one layer of the algorithm. So we don't just buy things because there's a caret. There's many different reasons why we put capital to work that are all written into the code. But I'm just showing you this. The NASDAQ 100 gave a risk on entry point on Friday on that rally there. Okay, so that's one piece to the puzzle, and it makes me say, okay, if one of the weakest indexes is telling me there's a risk on entry point, and the other indexes have not really hit stops, the Dow, the value, the most important S&P are all staying above their key levels, well, that means this risk monitor red at the moment is not going to turn into a market collapse. And if that's the case, I want to have capital back to work. And if we take out the lows of that down day that took us to support, which will take us below the uptrend and below the 50-day moving average on the S&P, then we will go to aggressive cash positions. Okay. But this doesn't seem to be the week that's going to happen. And I don't know what's going to happen, right? So we have to read and react. But I'm just saying, looking at all this information leads me to put capital back to work. Now, the last piece to discuss before I split here and we go back to work is massive alpha we're getting in precious metals. And so I just want to share with you all, these thoughts. I talked about it a bit in the in-game update. It's my goal. I really believe this is the year, and most years are like this, where value entry points, ARMR value entry points are the best ways to put capital to work. It doesn't mean you make money every time, but it's the perfect entry point from a reward to risk standpoint. You're not chasing, you're not buying momentum. You put names on the whiteboard. That's step one. Don't forget, there's 3 stages to the ARMR investing way. We fill the whiteboard up with ideas that we like. We don't go buy them just because we like them. We wait for value entry points. Then we put capital to work. They blossom and we start creating alpha. That's what works. And in some markets, like last year, you can chase ARMR momentum entries, right? You can chase momentum. But this market's not like that. Chasing momentum is deadly. So what we want to try to do is stick with the value entry points. And every now and then, I'll sprinkle in a couple of hybrid entry points, and I'll show you what I mean. But I want to stay as much as I can into the value entry points. And just to go over one example, Newmont's our favorite name. So it's on our whiteboard. We've been wanting to own it for a long time. Okay. We're waiting. We get this value entry point right at the support back here, right? This is the value entry point. That's where we bought it. And all the stock has done is made us money. And now it's making us mad alpha along with all of the other metal positions we have. And it's all because we seeded the portfolio with value entry points in early March. And so what we want to do now with any new money we put to work is find value entry points. Is it a fundamental story we like? And is it so close to the obvious terminal stop? That's what really makes it a value entry point, okay? If Newmont broke below these lows here, it's done. The story's over. The fundamental idea of metals going up is not going to happen, okay? But if it holds this level, this is the ideal entry point. And it did, and we were right fundamentally. The thing's going berserk. Now, I know I appreciate Erez putting this idea into the room because Rite Aid's on my list. Rite Aid's a perfect example of a value entry point. If you believe in Rite Aid's turnaround story, it blew out, it pulled right back to the 200-day moving average and stopped, right? And now it seems to be reversing. And ideally, Erez, I would have bought it actually Friday is the day I would want to own it. If you buy it here, you have to use Friday's low as your stop, right? If it closes below Friday's low, the story's not working. But that's a value entry point if you like the fundamental story. All right. So here's a couple of new stocks that I added to the portfolio that are precious metal names that are value entry points. So if you want to know where would I go if I want to increase my exposure in the precious metals space, I'm looking for names, the secondary names, the smaller cap names that are going to follow the leaders and are coming out of value entry points now, right? So here's the value entry point on Nova Gold. And I really like the value entry point on PVG, because this is a massive cup and handle actually on PVG. And there's your value entry point. It breaks below these lows right here. This is done. This story's not going to work. But if this precious metal story continues to run, that's where you buy PVG. And of course, we added shares of Sprott Physical Silver. I just couldn't help myself. That is an unreal pennant formation. And yesterday was day one of the breakout. All right. So we bumped up our exposure. We were 25 to 30% long precious metals. Now we're 32.5 to 40% long precious metals, depending on the portfolio and the size of our positions. That's probably going to be it. That's actually more than I want. But when you earn the right to take the risk and it starts going your way and you want to add some more, now's the time to do it. All right. So we just did it. CLF and FireEye and Illumina are probably the top three names I'd add to the portfolio that are at value entry points to me. Okay. All right. I'll see you guys on the other side. Be safe today. Be safe, meaning I think markets are grinding higher, but we want to take our time and make sure we take positions where we're not chasing, they're not hyped. We're trying to find names that are tight to bases. So our risk is minimal, but reward is significant. That's what we're all looking for. All right, guys, take care.